Hello and welcome. My name's Chris Can with Mining Journal, and with me I have Rule Investment Media Chief Executive Rick Rule. Rick recently signed an agreement with Aspermont across both the Rule Symposium and then Aspermont series of finance events, the Mining Journal and Mining News Select series. Across those events, Rick's going to be sharing his wisdom with us and our audiences, and obviously the Rule Investment Media audience as well. But we have got a little bit of a curtain raiser for you across a series of what we would consider the most investor relevant topics. Rick, thanks for joining us.
Chris, always a pleasure. Thank you for having me back.
We're going to start with gold, a good place to start, I think. And first question, is it all about interest rates, or are there other factors in play?
I think it will become all about interest rates, Chris. But if you look at the data, the retail investor who should be concerned about interest rates is still selling. The buying in gold seems to be about central banks. It seems to be about the weaponization of the U.S. dollar and the extraterritorial imposition of U.S. will on countries like Russia and China and Iran and others that aren't happy about it. If you look at the data, it would appear as though there is selling of physical gold in ETFs by retail holders and buying of physical gold by central banks, probably as a medium of exchange and a store of wealth outside the U.S. dollar. If you begin a circumstance, which I hope we'll see, where you see both retail and bank buying, then you'll see a real gold bull market. Then you'll see a bull market reminiscent of the 2000 to 2010 market, not the rather tepid market that we've experienced of late.
Okay. The view there sounds a little bit like we're anticipating some of these things coming together, but it hasn't quite happened yet. Would you be expecting some of these factors to come into play and we're at the start of a bull run, or is it very much kind of balls up in the air and we'll see where they land?
No, my suspicion is that we're going to have a real bull market, one where people aren't too concerned about a $30 or $40 move. I think it's useful that there's a whole bunch of reasons why retail investors should be nervous about saving in fiat currency denominated instruments. But thus far, the data would suggest that the buyers have been central banks. I really, truly do believe that investor perception around the maintenance of the purchasing power of their savings in other currencies will evolve. After all, it was slow to evolve in the period 1998 to 2002. It was slow to evolve, in the period 1967 to 1972. It makes absolute sense that investor perceptions would change and evolve only slowly now. What's interesting to see is the central bank involvement, which I don't think really has much to do with interest rates. It has much more to do, I think, with the American confiscation of $300 billion of Russian treasury assets, and of course, the weaponization of the SWIFT banking system. So my suspicion is that after a very long wait, that gold investors and gold speculators will do well.
Gold's not a big market, Rick. Does that mean that when it does move and when sentiment gets behind it, it's going to go really quickly?
I don't know if it'll go really quickly, but traditionally, when the tea leaves have been arrayed correctly in the cup, gold moves a long way. I read with amusement all of this excitement and chest pounding about the gold price going in U.S. dollar terms from 2,000 to 2,250. That's not a bull market. A gold bull market is 2000 to 2010, when it goes from $256, to $1,800 or $1,900, a sevenfold increase. I'm not saying you're going to see a sevenfold increase in gold, by the way, Chris, but gold, when it moves, usually really, really, really moves. And I guess one of the things I would say, and I think I've said it on Mining Journal podcast before, is that I'm not interested in a move in gold that's a $100 move. I'm afraid, literally afraid, that we're going to see a move to some number like $7,000 or $8,000, because that kind of move is going to suggest a circumstance that changes most people's way of living. And my way of living is pretty good. I understand ruefully to be careful about what I think may occur.
Let's hope that's not the case, Rick. And let's imagine a world where gold does go on a more traditional kind of bull run, not too catastrophic levels in parallel worlds. What's the best way in that scenario, in that more traditional scenario, to play the space? We've seen this distancing of equity prices, gold equities, against the actual value of gold, where they're not keeping up. People are buying physical gold. There are ETFs, majors, juniors. Is there a mix that you think is appropriate for the kind of market that we're coming into?
I think a mix is right, but I think answering the question it involves a deeper understanding of who it is we're talking to. With many people, there are many answers. I own some physical gold. I consider it to be good liquidity, uncorrelated with other types of liquidity. The first thing you do if you think the gold price is going to go up is that you buy some gold, which I began doing in 1998 again. The second to move normally are the major gold stocks. And for many investors, those who, as an example, don't subscribe to the Mining Journal, those who don't have access to deep information, or those who are either unwilling or unable to follow the information, my suggestion would be that you confine your purchases to the very largest and very best gold stocks, either by buying an ETF or, probably better yet, buying 4 or 5 companies that you consider to be the best companies in the ETF. If you are willing and able to do the work, the juniors are so deeply out of favor that my suspicion is when they come back, they'll have one of those really, truly eye-opening rallies that attracts people to them for the next 15 years. So I think it really depends on who you are. I would caution even your audience, Chris, a very sophisticated audience, not to own more stocks than makes them work too hard. Specifically, if you own 10 stocks, you should be willing to spend 10 hours a month studying those stocks, an hour per position per month. And that doesn't mean listening to fun videos. It means reading the quarterly reports, looking at the resource reviews, following the insider filing statements. Really, 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 truly work. If you are looking for market alpha, you have to work harder than other investors. For most investors, owning the best of the best is sufficient. When you see a gold equities bull market, you fairly frequently see 300% in beta, which is to say the best stocks can give you a triple over 2 or 3 or 4 years. For most people, that should be enough. There are always people, myself included, who are addicted to the hunt for 10 baggers or 15 baggers. Those people must work hard, they must take risk, and they must be able psychologically and financially to endure real volatility. For those who are, I think happy days are ahead of us.
Rick, that's all we've got time for, but we'll look forward to catching up with you across Miami, London, Perth, and Sydney throughout the year.
My pleasure. I'm looking forward to doing that too.